Joining us now to discuss is Aneta Markowska, chief financial economist at Jefferies. Aneta, I was talking at the top of the show. I don't know if you caught it, and I was looking at the dot plots from September 21, 1 year ago. Man, they were wildly off where we are now. Not one Fed member saw rates above 0.75 at this point last year. So how much faith do we have in the Fed forecast this time around?
Yeah, that's a good point, and that's sort of why I made a point that I don't see much value in the S&P, certainly beyond next year. But I sort of see the S&P as the floor, the minimum, right, level of rates, with risks probably skewed to the upside. So I expect the median dot for next year to basically move in line with the market, come in about 440, which is what was implied by the forward curve late last week. And I would say the risks are still that they'll have to continue to revise them higher.
How much higher could they go before the economy buckles, which I think is what they want to a point? I mean, it's the only way you're going to bring down inflation is by slowing down demand, right?
Absolutely. And the problem for the Fed is not just that inflation surprised on the upside in August, but when you look at the leading indicators of inflation, right? What do we need to see to have some confidence that inflation is on the right track? We need to see some softening in the labor market, which we really haven't seen. Initial jobless claims last week on non-seasonally adjusted basis hit the lowest level since 1969, right? So then you look at the leading indicators of employment, job openings. They haven't even begun to roll over. They actually ticked up in July as soon as energy prices came down. And then you look at the leading indicator of labor demand and job openings, which to me is profit margins, and they have not even begun to roll over. So there's really nothing to point to at this point that suggests that inflation is on the right track. So that's why I think that risks are still skewed to the upside for rates. And until we see evidence that margins are starting to compress, that job openings are coming down, it's really going to be hard for the Fed to pause.
I just wonder how much the statement's going to change. You know, everybody goes through the old statement, the new statement. You cross out the old words, add the new words. What's key to the language from the Fed?
So the last statement started with a pretty downbeat sentence, which said employment and production have softened. I think they have to upgrade that because the fact is that since the last statement, things have actually gotten better. Growth momentum has picked up. Even sentiment has picked up. And I think GDP is on track to accelerate pretty meaningfully in the third quarter. So I think they have to acknowledge that actually activity is improving, sort of moving in the wrong direction. I think the inflation language will be interesting. There's a good chance that they take out the reference to energy prices, pressuring inflation higher. And I actually think that they might acknowledge that inflation now is largely demand driven as opposed to supply chain driven. You know, I think that if you look at the latest round of CPI data, we actually saw an acceleration in core goods inflation. So I think that puts in question this assumption that a lot of economists have been making that supply chain pressures are easing and inflation is going to ease. Retailers are still raising prices aggressively simply because they can, because consumer demand is too strong.
Aneta Markowska, really appreciate your views. We'll let you get ready. If you see that Rich Handler guy walking around, you know, just tell him to get to work.